please subscribe and don't forget to press the bell icon to get notified whenever we upload a new video.
You're with us here on a fresh new edition of Taking Stock. This is the show where we look back at the week which has gone by, tell you what happened, what moved, what did not. And of course, more importantly, we look ahead to the week which is in front of us to try and decipher what is going to be important to track and to what degree. I am Prashant Nair. With me, as always, is my colleague, Surbhi Upadhyay. Hi, Surbhi.
Hi, Prashant. Not a bad week, I guess, for the Bulls, because they've managed to build a little bit on the rally that we saw yesterday. Not yesterday, actually, last week. And the good aspect, I think, for this time around, if you just go back and look at some of the internals, is that the participation continues to broaden. So one thing you can't complain about anymore is that this is a rally that's restricted to 5 stocks. That's not something that holds, because whether you're looking at the Nifty, where there are new hands and legs that are joining in the form of some of these corporate banks like Axis or ICICI, or even the broader market, the Nifty Junior, the Nifty 100, these are the pockets where we've seen a fair amount of traction now come in. It's been very earnings-specific, earnings-driven. There have been hits, there have been misses. So Tech Mahindra, for instance, started the week up on a fiery note for us. Towards the end, we had Titan's numbers where there wasn't too much of sparkle. That stock was a little lackluster. We had some disappointments in the form of Marico coming through and a Nestle coming through on the FMCG side. But then this has also been a week where we've reacted to good numbers from the likes of VIP or an Avenue Supermarts earlier on in the week. So it's very, very earnings-specific. But I guess the faith is intact, Prashant. And global markets have given us plenty of impetus this time around to take the rally forward, I guess.
Oh, absolutely. Surbhi, so, I mean, what we do is we kind of sort of set up the important, 4 or 5 key things. I mean, the rupee, the oil, yields, etc. And where they stand as we wrap up this week, and that gives us a clue as to how it looks next week. I mean, this is just FYI, the change on mid-cap, small-cap and Nifty indices that we've had this week. You know, the gains compared to last, I mean, the week before last, are essentially exactly half. I mean, small-cap and mid-cap indices were up almost 4 and 5% each, so they're much smaller, but still up. Nifty gains are about 1/3 of what we saw the prior week, but it's still up, 0.75%, and big thanks to Friday. Now let's come to the more important stuff, which is how are we stacked up for the coming week. Let's start with US stock markets, the Pied Piper, so as to speak. That, midweek, especially on the Dow, etc., it looked like it was faltering, but it continues to be strong. I mean, it is above that pivotal 2802 mark on the S&P 500. The broader indices like the Russell 2000, etc., look pretty solid. Data, no problem. There is one problem, which is the dollar, but I'll come to that later. But US stock markets looking good. If you want to sort of follow that as a Pied Piper of general health as far as equity markets around the globe are concerned. Oil prices, I mean, maybe a top is already in. It formed what is known as the evening star pattern right at the highs, and it looks like it maybe is headed southwards. There are too many moving parts here. Saudi Arabia, Iran, etc., etc. Who knows where prices will go? So sometimes, you look at the price chart, and maybe that gives, at least in the near term, a clearer kind of indication. And there, it looks weak. Look at the dollar rupee. I mean, the rupee was getting smashed, but the dollar rupee once again is failing at levels around the 68 or 69 levels. I've highlighted this before in prior weeks. This is the level around 68 or 69 where we peaked on previous 3 occasions over the last couple of years. Let's see if we do that once again. But again, not bad news for stock markets that the dollar rally seems like it's halting a little bit, especially against the rupee. Indian yields, which is the 10-year, the RBI hiked in the week. What the natural reaction is, yields actually go up, but yields actually went the other way. Yields went a little south. And I've highlighted this the prior week as well. Again, on charts, I mean, the yields look like they're weakish. I mean, some are calling for 7.5, maybe even lower. We'll see. The Nifty, no problem, continues to break new records. So, I mean, you add all of this together: US stock markets, oil. You look at the dollar against the rupee. You look at yields, the 10-year benchmark, and it doesn't give you exactly a bearish kind of a picture. It's actually giving you a bullish kind of picture for the coming week. There are 2 problems really with regards to the coming week. One is the dollar itself. You look at the dollar index, which is essentially against a basket of currencies. That is once again trading close to its 200-week moving average at about 95.33. It looks like, I mean, fundamentally or technically, it doesn't look like the dollar is going to stop moving higher. When dollar is strengthening, of course, one needs to note what is it strengthening against. But when, generally speaking, the dollar is stronger and firmer, it does indicate not exactly great news for emerging markets. That's point number one. And the second is the dollar yuan. That crossed the 6.9 odd level. At what point will, markets, stock markets and all other markets sit up and take notice and start to panic? We don't know. Will that be at the round 7 number? One doesn't really know. The appreciation of the dollar yuan was causing Asian stock markets, etc., to remain very weak and sell off. That stopped the last week, the prior week, and we've not seen any evidence of that happening now as well. But will a 7 kind of number on that currency pair, ruffle feathers? We need to wait and watch. So, I mean, that's broadly the setup. To my mind, globally speaking, those are the two things. One is China, as seen in the yuan, and the second is the broader dollar rally, which may start to hurt at some point. Okay, we'll put all of this and more to our guests on the show today. We are joined by Vikas Khemani and Aditya Narayan from Edelweiss, two market veterans who are going to tell us how they are feeling about the market. Gentlemen, thanks very much. Great to have both of you here with us. Vikas, if I can start with you, your sense, the market is looking better and better. And one complaint, which is only the large caps who are firing, that is also getting taken care of. Mid caps and small caps, once again, are bouncing. Your sense?
Hi, Prashant. I think, we have had some halt or some, bounce back in the mid cap, which is a good situation. I think that was worrying in the entire market, and I think partly it has been, corrected due to better corporate earnings across the board. And secondly, I think some point in time market made a hypothesis that flows, especially the domestic flows, might slow down. Fortunately, which has not slowed down. So some amount of money after the deep cuts of 30, 40, 50% in many mid caps, we started seeing value buying coming through. And as the markets worries are deciding, post interest rates high, yield kind of corrected. So I think the market worries are right now kind of settling down. So good part is that Indian economy is doing well, corporate earnings are doing well, interest rates are more or less close to the peak, in the near term. So I think that should give comfort. But having said that, I would not say the macro risks which we have been kind of worrying about, whether it is in form of currency disruption due to trade war or in terms of oil price. Still we do not have a clarity whether it will continue or it will. So those broad risks, and coupled with some of the domestic political events ahead, those risks are still here. So I would not say that with these kind of little bit of rally and all, I think we should still start painting a very bullish one-way kind of picture. Yes, happy news is that the economic corporate earnings are doing well, and I think these corrections are definitely very good opportunity for buying from a medium term to long term perspective. This vintage of buying over next 6 to 8 months, which is going to be fairly volatile period, would be one of the best vintage to invest into equities, because economy is on mend, but some of the macro risk might still keep the volatility higher, and I would say that volatility risk is not going away. That would be there, and one should keep that in mind.
Okay, all right. Well, let's also bring in Aditya into the conversation. Aditya, I want to take you up on the point that Vikas just highlighted, corporate earnings. Now, how do you rate the scorecard so far? And is the first quarter giving us enough confidence, enough impetus to build on this momentum?
Okay, I think to start with, the numbers are actually fairly good. They are not ahead of actual estimates if you aggregate them. But if you look within, which is what is EBITDA looking like, the numbers are actually reasonably impressive. In terms of building ahead on these, I think there are two elements to look at. One, I think for the year itself, general growth expectations are pretty high. So to some extent, I think there's little opportunity to really beat at the aggregate. But I think the second thing is important, as I said. I think the underlying is actually looking good. And I think the direction is what this quarter is effectively setting. I think up until now, it's really been mixed in terms of is there a revival or not. What this quarter has so far at least sought to address is the fact that yes, revival has come through, and then it's a question of the pace. If I were to step back and make a longer term call, I'd actually believe that this is the beginning of what should be a fairly extended run in terms of earnings being reasonably strong. But I'd caveat it by saying that I think in the past, people have tended to expect earnings cycles to be very, very sharp when they come back. I think this is going to be a longer run rather than necessarily a very sharp run. But yes, I think this is trend setting in some senses, and I think the debate on whether earnings are going to start coming back, I think that starts getting onto the back burner with this quarter.
Aditya, last time you were on the show, you were highlighting how macro is a bigger risk. Now micros are improving. Are you a bit more comforted now? Or, I mean, that still plays on your mind? That could interrupt this earnings recovery.
No,
yeah.
No, absolutely. I think Vikas just referred to the macro still being a form of headwinds. The way I would see it is, yes, it's something that you need to continue to watch for. But I think what has actually happened is that, we talked about the macro potentially coming half circle, and that's where it's actually got stuck. Here, I'd say it's a little bit more balanced, a little bit more steady, and it's looking a lot better today than it probably did a month ago. But again, to step back, I think the macros probably are the bigger risk than anything else. But yes, the pressure that was there sometime back, I think that has fundamentally kind of eased. And the RBI has been a little bit more cautious on this, so they've actually already pulled it up from a rate perspective.
Okay. Vikas, you just made the point that we're probably at the top of the interest rate cycle. So is that likely to be a big positive trigger going forward? And how do you rate this huge run-up that we saw in the corporate-facing banks? It all started with some good numbers, Canara Bank, BOB, etc., a decent performance perhaps by even an Axis Bank. How do you view this pocket? Because this is one under-owned area of financials.
Absolutely, and I think this has been a pain area for a long period of time. As I think we saw in last 3-4 years, the biggest problem was asset quality, and I think from recognition to provision we have come a long way, and we are probably almost close to the end of the provisioning cycle across the board, especially some of the corporate banks like Axis Bank, ICICI Bank, and some of the public sector banks. So I think you pass through that, and biggest advantage is that when the economic recovery happens, some of the assets which have been NPL, they would also start turning good assets, and the recovery would be far better than what you otherwise would have. I mean, we have seen in case of what has happened in some of the steel assets. So you will see many more of that sort of playing out. Some of the NCLT cases have shown very good recoveries, or expected recovery. So I think now market is making a hypothesis. Most of the pain is behind, provisioning is done, and some of the franchises which are or expected recovery. So I think now market is making a hypothesis. Most of the pain is behind, provisioning is done, and some of the franchises which are intact otherwise from a liability and lending perspective, both sides, I think can do very well. And I think that is where you see worst is behind, and market is overlooking even next 2-3 months, 2-3 quarters of possible pain still left. But I think market is kind of trying to now, and I agree with that I think probably some of the corporate facing banks like ICICI Bank, Axis Bank could be fairly, given where the valuations are of rest of the other pack versus these banks, could be fairly interesting spaces to look at. So definitely believe that the market is coming back and looking at that, and I think the biggest underlying thing is economy is on mend, and I think underlying economy will do very well. And interest rates, I think if the oil price does not surprise us on in a big way, if it doesn't go towards $90-100, then I think we are fairly under control, and which is where I think RBI also has maintained the stance. So I believe that if that is a surprise, nobody is an answer. But if that joker is still out, if that is okay, then I think we have seen most of the interest rates behind us.
Aditya, in terms of coverage, you have buys on ICICI and Axis?
Yes, we do. We have we have a buy on ICICI. We have a hold on Axis.
And what else in that space?
By and large, larger public sector banks we're positive on.
Okay. Gentlemen, another sort of development that took place since we last spoke was this whole specter of whether we're getting into some sort of a price war situation in the two-wheeler arena. It started with the, with the numbers from Bajaj Auto, and then slightly subpar performance, some would argue, from a Hero Moto. The announcement of Harley getting into the 250cc space. So there's a lot happening here, a lot of moving parts. How are you viewing the space now, Aditya?
We've been neutral in the two-wheeler space. On the primary stocks that are under coverage, we've been pretty positive on Aisha because that operates in a separate segment. I think price wars is not a bad thing in a situation when the market is looking up a little bit. you have already got a consolidated market space where I think at the end of the day, it's a product that is going to lead rather than necessarily the price. So what you actually end up having is probably a period of slight uncertainty over the next 2 to 3 quarters. But I think when you're operating within a consolidated market space, this is unlikely to spill over beyond that phase. So I'd actually say this is more a scenario of competitive positioning and one player trying to reposition himself a little bit rather than any reflection in terms of longer term dynamics as far as the sector is concerned. So a little bit of a hiccup for, obviously for stocks in that sector. But I'd just say the structure of that sector is actually about as good as it can get. And so it shouldn't be too disruptive.
Okay. In the same breath, Vikas, if I could get your thoughts on what's happening with the CV players, because again, a lot of headlines, some policy changes with these, overloading norms, the axle load norms. What would that mean for some of the CV financiers as well as for, companies like Ashok Leyland, that stock taking it on the chin because of these worries?
So yes, I think some of these changes have disrupted the rally which was continuing in Ashok Leyland and other stock. I think Tata Motors anyway is a more mixed story than really the CV story. So the only stock probably we are left with is Ashok Leyland. And but we do believe that I think market has slightly overreacted to the situation. Markets have almost hypothesized that 20% of the demand will go away and stuff like that. But I don't think it happens that way. According to us, of course, some amount of impact can happen. But as the infrastructure improves, the demand in CV is very, very strong. It is not going to go away, and I think we will see in time to come. That the impact on the demand of these changes is not as severe or as market is right now hypothesizing. The market tends to kind of expect a quick result or quick impact. It's like when GST got implemented, market thought that suddenly the unorganized will move to organized. It doesn't happen. It takes its own time. So same way when any such kind of changes happen, it doesn't impact the demand so easily. So much of capacity is not, the entire outstanding capacity has not gone up by 20% just because the extra weightage have been allowed. So I think markets have overreacted, but we remain positive. I think as the economy grows, you will see CV demand will continue to remain strong. In fact, some of the segments which will open up more demand. So I think we remain quite positive.
Aditya, do you have coverage on Interglobe? Any thoughts? The big price damage we saw, those the results?
Yeah, so it's so we do have coverage in that space. Obviously, this is a sector which is just much more vulnerable to external challenges like oil, right? And I think for players and operators in this space, I think it's a trade-off between do you take profitability or do you give up market share? And to some extent, I think all of them are really making the call that you need to grow with it. So it's a challenge. It is a sector which will fundamentally have these vulnerabilities. But you need to watch for oil that comes off, and these same numbers will see a dramatic reversal. But I think when you invest in this space, you actually go with your eyes wide open in terms of some of the risks that go, with the external elements of it. I think what is key to note is that demand has not dropped off. While they've obviously not been able to push through the price hikes they would have wanted, the reality is demand is still actually very good. And that is generally very encouraging for the sector. I think the problem happens when you push up prices, cannot protect margins, and you lose demand at the same time.
With the Vikas, with the market moving up the way it has, I mean, you can almost sense that chase, right? People, in a way, the fear of missing out kind of feeling, and the change in sentiment has been pretty dramatic. So for a lot of people, they'd be shell-shocked at the way markets moved up and turned around so quickly. But will we? I think when we were on the show last, you were saying that through the course of this year, because of state elections and then leading up to elections next year, you will get big market swoons. I mean, it's not going to be one way. It's going to be up and down, and some of these moves could be pretty large. So, do you still believe that it is going to be that kind of a market this year, all the way leading up to elections next year?
Absolutely, Prashant. I think, see, because there are stark positives and stark negatives. So markets are kind of fairly confused in terms of which will play out and, which will not play out, right? And, or maybe the timing of layout could be different. And hence, when markets are reasonably valued and there are lots of macro, global and local headwinds, any sign of negative development, market tends to overreact. And that is what has happened, in the recent past when stocks corrected. Some of the stocks even corrected 30, 40, 50%. They were definitely overreaction. So point is that you will see this kind of stark reactions in markets, especially when this kind of confused scenario is there. And I do not see that changing, because any development will have a sharp movement. If let us say tomorrow oil goes to 100, there's a big problem. If some trade war escalates and let's say currency disruption happen, I think the story of India's story will take beating in a short term reasonably big way. So the impact of each of these items is so big that any development on any of these, market tends to react and overreact in many cases, especially when we are positioned like this. So I think this I call it tug war will go on till the time, I think, in next 6 to 8 months. And obviously, it will also create interesting investing opportunity, especially for investors who have stomach to handle this kind of volatility in the shorter term, but definitely, can take a 3 to 5 years view. This is the market for those kind of investors to look for those opportunities and invest. And I continue to believe, and I reiterate that whatever we invest in this 6 to 8 months period in extreme volatile times, this vintage will be one of the best vintage for investing for long time.
Okay, all right, gentlemen, we will leave it on that note then for today. Thank you very much for joining in. That's the view from Edelweiss on the market and the sectors that they are watching carefully at the moment. We'll take a quick break. As we do that, let's leave you with a whole host of other market opinion that we gathered during the course of the week. We'll come back with Ashwini Gujral's technical view on the market and the trades you can look out for next week.
I think majority of the winners, in my view, will lie in pharma and banking. Now again, when I talk of banks, I'm not telling you to buy 40 banks which are listed. So there will be a few stressed, perceived stressed private sector banks and few public sector banks who have emerged, who have done significant cleanup in the last 5-7 years.
What we'll have to find out is what market is pricing in terms of growth versus what is potentially achievable in terms of growth. There will be pockets where market is priced in too much growth, like some of the consumption stocks or retailing stocks. And there will be pockets where market is probably priced in little less growth than what is achievable. This will be mainly in quality mid-caps where franchisee business is solid, governance is intact, and the business volumes are coming through as the economy has started recovering.
Welcome back. You're watching Taking Stock. Joining us now is Ashwini Gujral. Let's get a lowdown on the technicals and how the setup is looking like. Ashwini, let's first get your assessment on how we sort of ended off the weekend and where we stand right now. Roughly, market taking aim at 11,350. Do you think that this rally has more legs and more steam?
See, in this week, the market declined because of, global bad news, and finally was able to close at the highs of the week. That basically means that there is very little follow through on the downside, and now your trailing stop in a sense becomes 11,250, 270. So broadly the market still shows strength, and this is a much better rally than we had from 10,500 to 11,000, which is broad based. It has good leadership, and the rally is basically broadening out.
Ashwini, are we at a point where mid caps and small caps start to outperform large caps, relatively speaking at least?
Confidence is returning, and a lot of this decline was, artificial ASM and all that. Once, that is getting out of the way for many stocks, I think they are bouncing back like we saw on Venki's. Venki's basically came from 5,000 to 2,500 on the mid-cap correction, and finally the last 700 because of ASM. And now ASM is removed and suddenly it shoots up. A lot of these stocks, as they come off the ASM list, chances are will rally very sharply. So there's enough going on in broader market also. Whirlpool, VIP Industries, all sorts of consumption is doing well.
Okay, all right. So in that case, trading ideas for the week ahead, Ashwini?
Well, VIP Industries has a fresh breakout, so that's a buy with a stop of 520, target of 545. Godrej Agrovet is a buy with a stop of 648, target of 670. And Canara Bank has a fresh move, that's a buy with a stop of 287, target of 402.
Okay, 3 buys and a good way to close off the week. And the next one promises, Ashwini said, to be a good one. At least it looks like that at this point. It's a wrap from all of us here on this edition of Taking Stock, and we'll see you back bright and early Monday morning. Thanks
Have
for watching.
a great weekend. We'll see you soon on Monday.